Are you worried about the housing market being a bubble? Are you waiting for the bubble to burst before buying? It's understandable to wonder if prices will continue to increase or if there will be a crash. This is important to know whether you're buying, selling, investing, staying put in the home you own, renting, or looking to buy your first place. If the market's going to crash, it's better to hold off and buy something when it does. On the other hand, if it's going to continue increasing, it's a great time to get into the market. To figure out the best strategy for you, it's essential to understand the market fundamentals, which we'll talk about today. Hey, it's Zach Lowy here, realtor at the group in Northern Colorado. I'm a native to the area and have been a realtor since 2018. When you're ready to make a move, I'd love to be your guide. If you want to learn how to buy or sell a home and become the best homeowner you can be, please follow or subscribe for more videos like this. If you pay attention to the news, you've seen headlines talking about how insane the housing market is, how buyers are overpaying, offers way over list price, and things like that. News and media make money by being sensational. Gloom and doom headlines get readers. While that doesn't make much of what's reported necessarily untrue, let's unpack the situation and examine the true fundamentals of the market. And the place to start is to look back at where we came from. My job is to bring you the info so you can make the best decisions. Now, talking about this requires looking at a bit of data, so I apologize if that's not your favorite. If you know me, you know that I like to use the data to back up my conclusions. Quick disclaimer, I'm taking information from the sources I find credible and using that to form my own opinion. I study the data and know a good deal about economics, and it's up to you to use the information in your own way to come to an informed conclusion. Okay, let's talk about where we've been. The event that stands out in most people's minds is the housing bubble leading up to 2007. Most of us remember homeowners being upside down and homes worth less than what was owed. People treated their house like a credit card, pulling out equity left and right. We saw home values peak in early 2007, take a painful plunge, and bottom out in early 2011. This shock resonates in the public mind to this day. Let's talk about why today is not the same as 2007. This kind of double-digit appreciation happened around 2015 to 2016, and many predicted it to slow way down. So why are we here again? The simplest answer comes from basic economics, supply and demand. Let's define some terms. Supply is the amount of homes on the market. In the real estate industry, we call that inventory. It's sometimes referred to as months of inventory. This means if there's 2 months of inventory, it would take 2 months to sell all of the homes on the market at the current rate of sale with no more entering the market. The traditional definition of a balanced market is 6 months supply. Below 6 is a seller's market and above 6 is a buyer's market. Here we can see month supply of inventory going back to January 2012, which is just at the bottom of the housing market coming out of the Great Recession. So 4.7 months of inventory, pretty cyclical here as we go through each year. Pretty predictable. There was a funky blip up in the end of the year in 2017, which isn't too crazy because it was winter. Then you can see as soon as we get toward COVID in the beginning of 2020, we increased in inventory when showings were not allowed during the lockdowns, and then a steady decline due to supply and demand, ending up in less than 1 month of inventory in the last about 5-6 months. Now, the funny thing is, the way months of supply is measured is based on homes that are on the market, meaning not under contract yet. Homes are going under contract extremely quickly, so the month supply is low, but lots of homes are being sold. It's kind of like a retail store that normally has back stock, but right now does not. Supply is only part of the picture. The amount of demand is the other half of the equation, and the thing that matters to us is the demand relative to supply. If there's the same amount of homes for sale but more home buyers shopping, prices go up. Right now we have both lower supply and slightly higher demand driving prices up. We'll come back to why demand is so high in a minute. A large portion of supply is new construction. Between 1959 and 2006, there's an average of 1.1 million new home starts per year. During the housing bust of the Great Recession, many builders went out of business. So between 2007 and 2020, the average yearly housing starts was about 708,000. If that doubled to 1.5 million, it would take 13.8 years to catch up. COVID created a crunch for building materials, so home builders will gradually increase their production only as materials catch up and become more available. Another factor is that during the pandemic, many people who may have wanted to sell were averse to the risk of having people come into their home during the process and have simply held off. Many others who thought their home was perfectly fine found out that it didn't work for the lifestyle of working at home, kids at home, or maybe not going to the gym. This leads us into talking about demand. So you're probably asking yourself, why is demand so high? In the last 6 years, there have been 10 million new households formed in the US. Nearly 5 million millennials will be turning 30 in 2021, with similar numbers coming in 2022. Millennials are expected to continue to drive the real estate market for the next decade. And don't forget about Gen Z coming up just behind the millennials. The oldest millennials are hitting their late 30s to early 40s and are moving up into nicer homes. As a mid-30s millennial myself, I personally am in my second home. These generations will be driving demand for starter and move-up homes for a long time coming. Low interest rates are a significant demand driver. They've been historically low for a while now. A good rule of thumb is for every 1 point increase in your rates, your purchasing power decreases about 10%. So, although home prices have shot up, for sure, low interest rates have kept homes relatively affordable. Another demand driver is equity. The complete opposite of the early 2000s, 30% of US homeowners have 50% or more equity in their home. $21 trillion of equity is sitting untapped due to appreciation and people being much more careful to not end up upside down. As you can see in this graphic, even with record home equity, much less is being withdrawn. People are able to take this equity and move up into nicer homes. Something that's made the market more secure is lending regulations. Before 2008, pretty much anybody with a pulse could qualify for a mortgage, and that's only a slight exaggeration. 30% of the market was subprime and taking out adjustable rate mortgages. As a result, 42.2% of sales in the beginning of 2009 were distressed, meaning bank-owned, foreclosure, or short sale. Nowadays, 70% of borrowers have a FICO score of at least 760, and only 5.8% of sales are distressed, which is the lowest since 2003. So is this a bubble and will it burst? I don't think so. Supply is down, demand is up, and lending regulations are restricting home buying more to those who are better financially qualified to make the payment than in the early 2000s. I don't foresee these fundamentals changing drastically anytime soon. However, inventory is starting to improve as we recover from the pandemic. More resale homes will be coming to the market, and home builders will be playing catch up over the next few years. Demand may drop slightly for people who go back to working in person, kids go back to school, and this will make the need for a bigger house maybe slightly less important. It would take a major shift in one or more of these fundamentals to cause a crash. According to Nadia Evangelou, senior economist and director of forecasting for the National Association of Realtors, mortgage rates are more likely to rise than fall through the rest of 2021, and the economy is growing more quickly than expected as Americans get vaccinated and resume traveling. As consumers spend more, prices rise, putting upward pressure on rates. The Mortgage Bankers Association expects rates to rise to 3.7% by the end of the year from current low threes. This will cool demand slightly, but keep in mind that historically even 4% is very low. I predict that the current level of crazy price growth will taper off and slowly head back down to historical levels of 5 or 6%, maybe slightly more per year, rather than the 10 or 12, 14% as we head into a more normal school year and winter. One more piece of data here, historical home price growth since 1991. I showed you this chart before. Most recessions don't result in prices dropping. The big drop is of course the Great Recession that you'll see here, driven largely by the lending crisis. I don't see prices dropping overall. I see them increasing more gradually as they have over the long term. Of course, it might not play out exactly the timeline I'm predicting, but I think this is the direction that we're heading. What does all of this mean for you? If the COVID-19 pandemic hasn't made you want to move, make sure you've refinanced or your interest rate is low. If you do want to move, I believe it's an incredible time to do so because homes will continue to increase in value and rates are still amazing. Thank you so much for watching. If you've learned something here, I would really appreciate you giving me a like and subscribing or following to see more. If you have questions about real estate, call or text me at 970-689-2440 or email at zlowy@thegroupinc.com. I'll see you next time.